Good morning. Welcome to India's 102. Question number 51. Assume in the previous example, the choice of settlement is with the entity. The choice of settlement is with the entity. In question number 50, the choice was with the counterparty. And one more line. Also, entity has past history of cash settlement. Entity has past history of cash settlement means what will be the classification of this SBP? Will you treat it as SBP liability or SBP reserve? What will you treat? Based on this line, entity has the past history of cash settlement, so we will treat it as SBP liability. Calculations we have done. Yes or no? Calculations already done, so you just have to prepare this liability. After preparing this liability, there are 4 cases. They want cash, shares, somebody wants share, somebody wants cash, and then someone wants cash, share, and some lapses are also there. So what we will do? So write down. First you write a small note. It will be considered as stock appreciation right. It will be considered as stock appreciation right. It will be considered as stock appreciation right. Who has the choice? The entity has a choice. So entity can decide either to pay cash or to issue shares. Is it right? So first we will assume that the entity will pay cash. So draw this ledger. First we will assume entity will pay cash. So if entity is expected to pay cash, then your life is easy. Write down please. Provision for SAR account. Format you are aware. Date particulars rupees. Go to your previous answer. Case A. Question number 50, case A, provision for SAR account you have prepared. Good news. Same thing you have to copy. Oh, so easy. Yes. So just copy paste the same thing, because if it is provision for SAR, the calculation will remain the same. By employee compensation expense account. Question number 50, case A. Same thing you have to copy. Was it 39292? To balance carried down. 39292. Same thing. Only provision for SAR you have to copy again. 1419. By balance brought down. 39292. By balance brought down 39292. By employee compensation expense 47828 is right. To balance carried down. 87120. Third year 142020. By balance brought down. 87120 by employee compensation expense 48330. 48330. And now you write down to bank. because the choice is with the entity, so entity may pay full cash and settle it. So to bank 135450, to bank 135450, take the total. One three five four five zero, you got it? Now write down a note. Since the entity has a choice, either it will be cash or equity. Entity will not take a lottery system and decide this employee will be given cash and this employee will be given equity. Yes or no? Who has the choice? Entity. When employee had a choice, he could decide. Now I will decide either or. Either or. So suppose in your exam this question comes and they say the entity initially wanted to give cash, you did the accounting, but in the third year you changed your mind. So what will be the treatment? Write down. If the company issues shares, if the company issues shares instead of cash, if the company issues shares instead of cash, provision for SAR account, provision for SAR account and SBP reserve account and SBP reserve account and SBP reserve account will appear as follows, in the third year, will appear as follows in the third year. So what I'll do, I'll prepare the third year provision for SAR again. Third year provision for SAR again, buy balance brought down 87120, buy balance brought down 87120, buy employee compensation expense 48330, credit side same. What about debit side? You are not going to pay cash. So what will happen to this difference on the debit side here? Anybody answer? To equity share capital, not directly. To SBP reserve first. To SBP reserve first. To SBP reserve first. 135,450. So first you transfer there because you have to receive the money also, exercise price also. Then we'll prepare SBP reserve account. SBP reserve account give the credit effect. There is no opening balance, okay? Because we never prepared this account if the choice is with the entity. So buy provision for SAR account 135,450. If the employer wants to issue shares, then employee will have to pay exercise price. Buy bank 86 employee into 50 share into 18 rupees, 77,400. 77,400. Is it 77,400? To share capital 43,000. Come on, is it right? And two securities premium, balancing figure 169,850. Wonderful. 169,850. Now here I will not take the breakup of 52 employees, 32, 4 employees like this, because who has the choice? Entity has a choice. So how will entity decide 52 wants cash or 32? They don't know. They will decide. They are not giving you the choice. Is it right? So they will either give cash or shares. Anyway, this is the answer of this question. It is a continuity of the question number 50. So you have now studied stock option with cash settlement alternative from the point of view of both employer and employee. If employer has a choice, this is how the accounting is done. If employee has a choice, you have done the accounting in question number 50. Is it right? Now we'll do some practice on this type of problem. Next question, 54 first. Come to 54 first. 52 and 53, I will take it after this, okay? 54 number, 52, 53, answer is printed. We'll discuss it, but 54 I'll take first. Once you take 54, you will find 52 and 53 are copy paste version only. Right? Say yes. Yes. On 1st January 2080, Ambani Limited grants its CEO an option to take either cash equivalent to 800 shares, okay, or 990 shares. So what are the two choices to CEO? If you take cash, it will be equivalent to 800 shares. If you take shares, then you will get 990 shares. The minimum service requirement is 2 years. There is a condition to keep the shares for 3 years if the shares are opted. So that is called lock-in period. It is called lock-in period. Liquidity is reduced. Due to lock-in period, the liquidity is reduced. So which share will you prefer? With lock-in period or without lock-in period? Without lock-in period. Everybody wants to be independent. Okay, we love freedom. So now they are saying fair value of share. Share alternative fair value with restriction 212. So this is applicable for equity settled. If he wants equity, because if he takes equity share, there is a restriction. So I will take fair value of the share with restriction. Then grant date fair value is 213. This I will take if he opts for cash. If he opts for cash. Then why these two fair values are given? These two fair values are given for cash settlement, remeasurement. If the company calculates liability, the liability has to be remeasured. The liability portion has to be remeasured. So this last two will be required for remeasurement of the liability component. The key management exercises his cash option. So what Ambani wants? Cash. Ambani wants money. Okay. On 31st December 20x1, he says take cash only. Why to buy share and stick for 3 more years? Cash is the king. This question was asked in MTP August 18 and study material. So very important question. You should revise it a day before exam, okay? It deserves a revision because it has been repeated many times in many institutes publication, which you will see after this. So what should we do first? What should we do? Give me some guidance. I forgot. Yesterday when I slept, I lost all my memory. First, I will find out what is the value if it is equity settled. What is the value if it is cash settled? If equity settled is more than cash settled, the difference will be SBP reserve. Is it right? And then I will prepare one provision for SAR account, and I will prepare one SBP reserve account. But instead of that, this time they have asked us to pass the entries. So no problem, we will prepare entries. And after 2 years, we will pay cash. Money wants money. Okay. That's it. Such an easy question. And every year, you have to revalue the liability portion. You have to revalue the liability portion at the end of every reporting date. Got it? So start. First write a small note. Write a small note. This question has not given whether these three fair values are for equity settlement or cash settlement. But then you have to understand this is the style of the institute, that with restriction is for equity and the others are for cash settlement. Okay? They should have mentioned it more clearly, but they don't do it. But past 4 or 5 questions they have asked in MTP, RTP, study material exam, that is the process they have also followed. Yes or no? Yes. Right. The last three fair values given in the question are for cash option. The last three fair values given in the question are for cash option. The reason is that we will require fair value of cash option. We will require fair value of cash option on each reporting date. On each reporting date. Now, step 1, calculation of equity component, right? Fast. Same problem we are doing for practice. Equity component. This is the compound instrument, okay? It contains some portion of liability and some portion of equity. So I need to find out how much is this equity portion. So write down first, assume it will be equity settled. Assume it will be, if it is equity settled, what is its fair value today? What is its fair value today? So you will say fair value of equity settled option. Fair value of equity settled option 990 into 212. 2,09,880. 2,09,880. B. B, write down fair value of cash settled option. Fair value of cash settled option. So if you go for cash, you get 100 share, 800 share. And the value of this share today without restriction, with restriction I will take here. In case of equity settlement, there is a restriction to transfer the share for 3 years. But of course, you can't put restriction on cash. So this 213 is for cash settlement. Multiply 1,70,000. So this liability part is 170,400. The total value of this compound instrument is 2,09,880. So the remaining portion is called equity component. Check the answer. 39,480. So this is 39,480. Substance over form. Liability portion will be accounted as SAR. Equity portion will be accounted as SBP reserve. This will not be revised, but it will be allocated proportionately. In this question, there is only one employee. So question of number of employee will not be there. Is it right? So only 39,480 will be spread over 2 years, and liability will have to be remeasured on every reporting date. So first I'll prepare few working notes so that we can pass the journal entry smoothly. Yes or no? Step number 2, little fast now. Calculation of expense. Calculation of expenses. 31st March 2080. 31st March 2080. We have to do the calculation for equity settlement and cash settlement. Point number A, equity settled 39,480 divided by 2, 19,740, 19,740, check the calculation. And then cash settled. For cash settled, check the fair value at the end of the year, 220, 220. How many cash? If he opts for cash, he will get 800 equivalent. 800 equivalent, 800 into 220 into 1 by 2. Divided by 2 you have done? 88,000. Repeat it for next year, only 2-year problem. Come on, 31st March 20x1. This time you will write, I will check. You will write, I will check. You will write, I will check. 97,000. Equity will be same, don't waste your time. I am asking for cash settlement. One student is saying 97,600. Is he right? Let us ask computer G. 800 into 232 into 2 by 2 minus 88,000. Come on. Is it 97,600? 97,600. So now we have got all the figures ready. We are going to pass entries for these numbers. Okay. And then in the last year, second year, Ambani will get money. Ambani gets money. Okay. So that we will pay, and balance in SBP reserve we will transfer to general reserve. So this is a good question for 4 to 6 marks. Start. If they ask journal entries, student will write journal entries. If they ask ledger, student will prepare ledger. So I have done ledger also. Now I am telling you journal entries also. Rest is your good luck. Okay. Start. Format about 1 page, about 20 lines. 31/12/20x0. 31/12/20x0. Employee benefit expense account. You have to take the total of equity settlement and cash settlement first year. Anybody? No, we will create directly in the last day of the year only. First was only for finding out the amount. On grant date, we have to find out the SBP reserve account, but we don't pass the entry because the employee has not rendered the service. Without rendering the service, how will you create the liability or any account? If it is immediately vested, then, but it is not immediately vested. Ambani does not work like that. Okay. Ambani Limited will say first work, then vesting. Okay. To SBP reserve 19740. To SBP liability 88,000. Check that from your previous calculation. Is it there? 107740 is the total. Being expense recorded. being expense recorded. Then same date transfer employee benefit expense to P&L account. In the exam, as I said earlier also, pass the entry for transfer to P&L account separately. So P&L account debit 1,07,740 to employee benefit expense account 1,07,740. Yes, being expense charged to P&L account. Being expense charged to P&L account. One line blank. We are changing the year now. 31/12/20x1. 31/12/20x1. Come on. Entry. Employee benefit expense account debit total 1,17,340. The total of SBP reserve 19,740 and SBP liability 97,600. Very easy question. This is nothing but bonus marks. Total 117,340. Narration homework. 2 lines blank for narration. 31/12/20x1. P&L account debit 1,17,340 to employee benefit expense 1,17,340. Narration homework. Now what Ambani wants? No, money. Ambani wants money. Not cash. Don't disrespect. Money. So how much amount of cash you'll have to pay? Total balance in this SBP liability account is this amount. And this also we will assume is intrinsic value also. Yes or no? What is the total? Total of 88,000 plus 97,600. 185? 600. If nothing is given, take that amount only and pay. To SBP liability account debit 185,600. Total amount payable is 185,600 if he opts for cash. To bank 185,600. Narration being settlement in cash. But there is a small account which is still open. This SBP reserve account, total balance lying in this account 39,480. Now the SBP settled. So SBP reserve will be transferred to, right, SBP reserve account debit 39,480 to general reserve 39,480 being amount transferred. Okay, this is the answer of this simple question. You should practice and you'll get full marks, because we have written everything that was supposed to be written. Okay, if they ask you to prepare P&L account also, then these two amounts will be transferred to P&L account. These two amounts will be transferred to P&L account. And if they ask you to prepare balance sheet, SBP reserve will appear under the head other equity, and this will appear under the head liability. SBP liability will appear under the head liability. One question number 52, come turn the page behind. Is it there 52 number? You will be happy to note it is exact replica of this previous question. On 1st January 20x1, ABC Limited gives option to its key management employees to take either cash equivalent to 1000 share or 1500 share. If you want cash equivalent to 1000 share, if you want share, you will get 1500 shares. The minimum service requirement is 2 years. Shares being taken must be kept for 3 years. Same question. And it also has a lock-in period. If it is a lock-in period is there, then the fair value of the share gets reduced because it does not have liquidity. That is why on the grant date they have given two fair values, one with restriction and one without restriction. So with restriction I will use for equity settled value, and without restriction I will take for cash settled. Then two more values are given for cash settled option. Same like previous question. The key management exercises is cash option. Here also cash option. Same problem. Past journal entries. Answer is there. I'll explain. Their format is different, but you'll understand. First, what you do on 1st January, you will find out whether there is equity component or not. Whether there is, so I will take, if I go with equity alternative, the value of this plan is 1500 into 102. Check the calculation and tick mark like you do in your office, tick mark. Okay. 1,53,000. If I take cash settlement, today the value of this contract is, today the value is 1,13,000. Check. Because the equity is more than cash, that means there is some SBP reserve. There is equity component, and that is equal to 40,000. So this is like our working note 1, which we did earlier. They have done in one table only. Now let us see the accounting for cash option. Now they have computed the expense. How many employees are there? Only one. So then you just take 1000 share. What is the fair value on 31st December? 120 into half. So that gives you 60,000. And then in the next year, it is 1000 into 120, 1,32,000, correct? That is called cumulative. Then equity option also, equity option cumulative. Total you have got 40,000 here. That you divide by 2, you get 20,000, and then cumulative 40,000. Now what they have done, they have calculated the expense for the period by deducting previous year figure. So equity option, this 20 will come here, and how this 20 has come? 40 minus 20, 20, 20. Cash option, first year this 60 will come. Guess the second year, 132 minus 60, so that comes here 72,000. That is what we also did. If you like this format, follow this. If you like the other format, follow that. And now the journal entries. So journal entry will be employee benefit expense. First year is 20 plus 60, 80,000. To SBP reserve 20, to SBP liability 60. Is it right? If it is right, tick mark. Next year. And what you do in your book, write here P&L account. Institute in its answer has not written P&L account, but they will deduct marks if you don't write. They are allowed to do. They are kings. We are subjects. Yes or no? They are salute the boss, correct. Employee benefit expense account debit 92,000, second year. SBP reserve 20,000, SBP liability 72,000. This is the entry, and you write here in bracket P&L account. Then we will pay liability 60 plus 72, 32 to bank, being settlement in cash. and then this SBP reserve 20 plus 20, 40 will be transferred to general reserve. Done. Same answer. Whose presentation is better, our or institute? Our institute. Okay, our institute. That serves both the purpose. One more question, same problem with solution. Is it there? This question was asked in MTP April 18 for 15 marks. Is it a joke? Yes, sometimes. And from Ambani they made it Tata. So next time what? Guess. Adani has issued a share option to one of its key management personnel which can be exercised either in cash or equity. It has the following features. Then option 1, if you go for cash settlement, you will get 74,000 share. Okay. And if you for that service condition is 3 year. Second choice is you can opt for cash, then you will get 90,000 shares. The condition is, there are two conditions. First, complete 3 year of service. Then you can't sell for 3 years. You can't sell. So there is a restriction on transferability. Now they have given fair value. So what is the only difference between this and the previous two questions? It is a 3-year problem. Previous one 2-year problem. Okay, no problem. Very easy. Fair values. Equity price with restriction. This will be required for equity settled value. Fair value granted. This will be required for cash settled. We will use these two numbers to find out if there is any equity component on the grant date. Yes or no? And then these 3 dates or 3 prices are given for cash settlement, because you have to do fair value measurement every time. Now this question says pass journal entries. There is a small error in the problem. They have not specified what they have not specified. Whether it will be finally settled in cash or whether it will be finally settled in shares. Oh, now the student will get confused. So you have to be a decision maker. Okay. Solve twice in the last year. Assume cash settlement also and assume equity share settlement also. If the question is silent, and write a note. But first I will check the calculation. Everybody is ready? Check the calculation. Answer is there. You have to tell me whether this calculation is right. So first my task is to find out equity component on grant date. Yes or no? And for that, this exercise they have done. In different answers, different formats are being used. Here they have said fair value of equity option component, number of fair value of share with restrictive clause 115. Is it there? So how do you take, this way or this way? Anyway, your office must have told you how to take mark. No, there are rules of doing take mark. Number of shares 90,000. So fair value 1 crore 3 lakh 50,000. This is if it is equity settled. Then they are writing fair value of share on grant date 135. Number of cash settled share is 74,000. Multiply these two. Fair value 99 lakh 90,000. So this is if cash settled. If cash settled. So compare A versus B. If A is greater than B, then there is an equity component in this instrument. So the answer is yes, 3,60,000. Is right, 3,60,000. And this time what the institute has done, they have not done the calculation only for the expense. They have directly done that in the journal entry only. But you should do it as homework. Write homework. Prepare working note for expenses for all 3 years. Working note for expenses for all 3 years. You will be able to do? Yes. Yes. And now we'll check in the answer only. Now they have given you journal entries. Journal entry on 31/12/20x0. You have to just tell me whether it is right or not. Employee benefit expense account debit to share based payment reserve is every time 1,20,000. Do you agree? Why? 3,60,000 divided by 3. So this figure is going to be same. What about this SBP liability? In your question, if you see, there is 138 rupees given into 74,000. This is the first year, so divide by 3. Minus 0 if you want to write, but not required. 34,04,000. Take the total, check if it is tallying. First year is the total 35,24,000. Very good. Kindly come to year 2. Year 2 to share based payment reserve 120 will be right. Check this figure. To SBP liability, what is the fair value? 140 into 74,000 into 2 by 3 minus previous year. This is the previous year. Tell me the answer. 35,02,667. Now take the total of these two and check this figure. 36,22,667. Then come to third year. Same process I'll repeat first. To SBP reserve is 1,20,000. To SBP liability check 147 is there into 74,000 into 3 by 3. That is cumulative minus previous 2 year minus this and minus this. Give me the final answer in the last column. 3971,333. Take the total of these two. 4091,333. So 3 years are over. Now this question is silent as to what happened. So we will write here our assumption upon cash alternative chosen. Upon cash alternative chosen. So I will write SBP liability account debit to bank. So you can do the calculation in two ways. 147 into 74,000. How much? Or you can add these three figures. Add these three figures, you will get this answer. Both ways you will get the same result because finally you have valued it at 147. Yes or no? And what will happen to that SBP reserve? Transfer to general reserve, but they have not done. Can you see they have not done in your answer? Oh my God. So you will have to enter one more entry here. After this bank, here one more entry should come. So wherever you have space, write or write in the notebook. SBP reserve debit, Haji, 3,60,000 to general reserve 3,60,000. To general reserve 3,60,000. Have you noted it? Yes, so there is a mistake in the answer. Now suppose this fellow wants equity. This fellow wants, first what I'll do, whatever balance I have accumulated here, that is treated as a consideration for equity share. So I will transfer it to, come on, SBP reserve. So what they have done, they have made a mistake in your answer. They have written share capital, which should be SBP reserve. Just rectify this. If your book has a wrong account heading here, please rectify. SBP reserve. SBP reserve. How much? 1 crore 8,78,000. Then we have to issue shares from SBP reserve. Is it right? So the entry will be, that entry they have not mentioned properly. So you will write SBP reserve. Please write SBP reserve account debit below. You have some space, then write. Otherwise write in notebook. Now SBP reserve will have how much balance now? 3,60,000 was already there. 3,60,000 was already there plus this 1 crore 8,78,000. So how much is that? 1 crore 12 lakh 38,000 to equity share capital. How many shares are there? At least you can tell me the shares. 90,000 shares are there. So 90,000 shares. And assume face value 10 rupees. Assume face value 10 rupees. So how much is that? Is it 9 lakh? To equity share capital 9 lakh. And to securities premium balancing figure. 1 crore 3 lakh 38,000. 1 crore 3 lakh 38,000. Last entry I will repeat if you can't read it properly. SBP reserve account debit 1 crore 12 lakh 38,000 to equity share capital 90,000 into 10 9 lakh to securities premium 1 crore 3 lakh 38,000. Now you close the answer. Write an assumption. Face value of share is assumed to be rupees 10. Face value of the share, keep writing, is assumed to be rupees 10. Noted? So in the exam you can write 10 rupees here, no problem. So there are few errors in the answer. One, they have not transferred the balance in SBP reserve to general reserve. Second, in the equity settlement, they have not transferred it to SBP reserve. Directly they have issued share capital, so the amount is wrong because there is a 3,60,000 lying in the SBP reserve account also. Yes or no? So what happened to that SBP reserve? They have not given in the answer last year. That is a minor error, but you have rectified. So this completes one more type of question, that is share based payment with cash alternative. Okay. Now the next question number 55. This is from business combination chapter. Oh, do you remember in business combination chapter? First let me ask another question. What is the standard number for business combination? 108? 3. Okay. Did you discuss about this share based payment in that standard also? Yes. The employee of the acquiree, they were issued share based payment plan by the previous company, acquiree. Acquiree is taken over by acquirer. Acquirer is taken over by acquirer. Now these employees have gone on strike mode. Why? He says, what will happen to my ESOP? This company is taken over by other company. So what happens to my ESOP now? So they said, we will not agree to this merger. Acquirer says, don't worry. We will replace the award. That is called replacement award. Is it right? Do you remember replacement award now? Yes. But he says, I have already completed 3 years of service. What happens to that? That will also be counted. Is it right? That is also considered. So what we do, we divide our calculations into two parts. One is for pre-combination service and one is for post-combination service. Pre-combination service forms part of purchase consideration. Here the services have already been rendered and this will be accounted under IND AS 102. So whatever is the post combination expense, that will be transferred to P&L account over the remaining vesting period, as usual over the remaining vesting period, and this will form part of PC for business combination. So this question is a revision of business combination, a small part there, when that acquirer company issues its own ESOP to the employee of the acquiring company, right? Entity X acquired 100% of entity Y in a business combination as per IND AS 103. There is an existing share-based plan in entity Y with a vesting condition for 3 years, in which 2 years has already lapsed at the date of such business acquisition. So what was the original vesting period? VP, 3 years vesting period. Completed 2 years. Entity X agrees to replace the existing award for employees of combined entity. The details are as below. Acquisition date fair value 300. So this is the fair value of original award on acquisition date. Number of years to vest after acquisition, 1 year. Oh, wonderful. So original vesting period is 3 year. Completed 2. Remaining year how much? 1. So number of years have not changed, because under the new scheme also he has to complete a total of 3 years. Number of years remaining 1, and the fair value of the award after replacement, this is the fair value of the new award. So we will see the calculation. Calculate the share based payment value as per IND AS 102. This question is there in IND AS 103 chapter also, but because it is a part of this chapter also, we have discussed there, but we have taken 6 or 7 questions in that chapter 103 because it's more relevant there. So write down the answer. We have done this question, already done, only data was different. So first write down the basic numbers. Pre-acquisition period 2 years. Post-acquisition period 1 year. Total fair value at acquisition 300. Original vesting period 3 years. Revised vesting period is also 3 years, 2 plus 1. Revised vesting period is also 3 years. Why I have written this? If you remember the formula, then you will realize. The formula is, hello, formula, don't remember. Why? It is just some weeks ago only we have done. The formula for calculating value of consideration, which will form part of PC, is a small formula. Fair value of the original option, fair value of the original option on acquisition date, on acquisition date into completed year. Oh yes, now do you remember? Divide by original vesting period or revised vesting period, whichever is higher, whichever is higher. Original vesting period or revised vesting period, whichever is higher. Okay. So what is the fair value of the option on acquisition date? 300. Right, 300. Number of years completed to divide by 3 years. So 200 rupees will form part of purchase consideration. Accounting we have done in 103, so we will not discuss again. Refer Ind AS 103. Right here, refer Ind AS 103 also. There we have taken many practices. And how much will be treated as post combination expense? So write down post combination expense. Anybody, any idea about the formula? I will take fair value of the replaced award minus pre-combination expense. Is it right? Fair value of the replaced option 400. This is the total expenditure I should recognize based on revised terms and condition. But out of that 400, 200 is already recognized as a part of purchase consideration at the time of business combination. So write down value of option transferred to SBP reserve on acquisition. Therefore, post combination expense 200, and this will be transferred to P&L account over the remaining vesting period, which is 1 year. So future vesting period is 1 year. For your benefit, write a note. Similar questions have been covered in IND AS 103. Similar questions have been covered in IND AS 103. So today's homework, revise the entire chapter. Okay? Revise the entire chapter, because we have covered almost every problem which is there in this chapter. One question I will dictate which is not there in the institute's material. Taken from one foreign author book. This question is based on modification that is not beneficial to employee. What do we do with modification which is not beneficial to employee? We ignore it. Is it right? We will recognize planned expense only. Question: an entity grants 100 share options to employees. An entity grants 100 share options to employees at an exercise price of rupees 10 per share. At an exercise price of rupees 10 per share. The grant date is 1st January. The grant date is 1st January 20x4. And the options are subject to a 2-year service period. Options are subject to a 2-year service period. Next line write, the grant date fair value of each option is rupees 50. The grant date fair value of each option is rupees 50. The entity modified the option. The entity modified the option at 31st December 2000x4 by extending the service period to 30th June 20x6. By extending the service period to 30th June 20x6. Have they increased the vesting period? Yes. But have they given any benefit to the employee? Let us see. Next line. So only increasing the service period is harmful for the employee. Yes or no? Only increasing the service period with no other benefit is unfavorable to employee. That is what issue we have taken here. Next paragraph, at the modification date. Management expected that the number of options outstanding at 31st December 20x5, that is the original vesting date would be 90. The actual number of options outstanding at 31st December 2005 was 85. Of these only 80 vested on 30th June 2006. Up to this it was normal, but then the last line is important. The modification did not increase the option fair value. If it did not increase the option's fair value, that means there is no additional expense. Correct? If there is no additional expense, we will recognize planned expense only. Everybody has noted? Okay. So I'll just read the problem once again for you. The problem says, An entity grants 100 share options to its employees at an exercise price of 10 rupees. This is the grant date 1st January X4. And originally what was the vesting period? 2 years. So 31st December X4 first year, 31/12 X5 second year. This is the original plan. The grant date fair value is 50. 50 rupees fair value, 100 shares are there. Now it says the entity modified the option on 31st December. Oh, this is date of Modi. Okay. Modification. This is the date of modification. What they have done? They have increased it to 30th June 2006. So which means some number of months they have increased. So assume it is your article chip, okay? 2-year article chip increased to 6 more months. How will you feel? Without any other benefit. It says there is no increase in option fair value. So no further benefit, but only increase in the vesting period. It is unfavorable. Now to confuse you, they have given on modification date, management expected number of options. So here I have to estimate how many employees will serve the vesting period. So my first estimate was 90. When I went to this date, I found only 85 employees are there. And on this date, only 80 employees are there. So the question is, first year accounting will be no problem. First year you will take 100, not 100, 90. 10 have left. 90 into 50 divided by 2. First year expense will be 90 into 50 divided by 2. 2250. Now, will you take 1 year for amortizing the expense, or will you take 1.5 year for amortizing the expense? 1 year or 1.5 year? When you are doing the accounting here, will you recognize the remaining expense or will you recognize proportionate expense because 6 more months are pending? We'll take planned expense only because this is not favorable for the employee. Is it right? So my calculation will be based on 2 years only. 85 into 50, that is my total expense, minus previous year. Previous year was 2000. 2250. Answer is 2000. Done. 2250 for this year. 2000 year. No expense will be recognized on 30th June. Is it right? So this was another type of question which is not there in ICI any publication. What happens if the vesting period is increased without change in fair value of the option? It is unfavorable. If it is unfavorable, we will recognize it over the original vesting period only. So write down the answer. This is a new question, not in any material of the institute. The extension of the service period should be ignored. Write fast. The extension of the service period should be ignored. Modification of vesting condition. Modification of the vesting condition in a manner. Modification of the vesting condition in a manner that is not beneficial to employees. That is not beneficial to employees. Write fast. Should not be taken into account. Should not be taken into account when determining amounts to be recognized. When determining amounts to be recognized. when determining amounts to be recognized. Okay. Now write down the expense and corresponding the expense and corresponding increase in equity. The expense and corresponding increase in equity for 2004, that is first year, is equal to 950 rupees into 90 option into 1 by 2. So 2250. Then write down second point. The expense and corresponding increase in equity. The expense and corresponding increase in equity recognized in 20x5. 50 into 85 into 2 by 2. Understood? Minus rupees 2250 expensed in 2004 minus 2250 expensed in 2000 x4. So the answer is 2000. Okay. Write a note and complete the answer. Note: no expense is recognized. No expense is recognized in 20x6 and no adjustment is made to reflect the fact that only 80 awards actually vest, because this occurred after the original vesting date. Because this occurred after the original vesting date. Okay, so that was a question on increase in vesting period without any benefit to the employee. Sorry. Done, everybody? Take a photo. With your speed, we need 6 hours to complete the exam. But unfortunately, it's only 3 hours. So come to the book again. Last few points. First time, take photo. 10 rupees for royalty. Sorry. First time application of IND AS 102. This paragraph is from which standard? Guess. It is from IND AS. Neighbor only. Who is the neighbor of IND AS 102? 101. First time adoption of IND AS. So that we are going to learn soon. But for the time being, the related issue is so let us start again. So first time application means understand what is going to happen. In India, there will be many companies who are going to apply IND AS for the first time because they are following old gap. once they fulfill the conditions of IND AS, listing criteria, net worth criteria, or if they are subsidiary of parent company which is following IND AS, etc., then they will have to change their accounting from old GAAP to new GAAP, that is IND AS. So they have to upgrade themselves. So there will be a transition date. There will be a transition date. Whatever they have done under old GAAP, they have to bring it as per IND AS. The opening balances will have to be brought as per IND AS. So what we were doing earlier, we were following a guidance note. We are following a guidance note on employee share based payment. Under this we had two choices: fair value method, intrinsic value method. This IND AS has only one method, that is fair value method. So therefore the balance lying in SBP reserve account or SBP liability account under old GAAP can be different from the new GAAP. Is it right? So what they are saying, since you are applying it for the first time, we will give you some relaxation if the options have already been vested. If the options have already been vested, then some relaxation will be given to you, because now it is already vested. So it's a matter of only issuing the shares now or paying cash now. Either payment of cash is pending or issue of share is pending. Service condition, performance conditions have been satisfied. So for such options which have already been vested, you are given two choices. The entity can either, if it wants, do retrospective calculation. Retrospective calculation means as if you had followed IND AS 102 from the very beginning, from the grant date only. So find out what will be your additional liability and adjust it against retained earning. First time application, adjustments are made in retained earning. Second choice, don't do anything. Whatever is the balance under old GAAP will be continued for IND AS 102 purpose also. Okay, no change required. This is a relaxation. You don't have to go behind. Suppose grant date was 4 years earlier. If I apply this standard, I have to find out fair value on grant date, which was suppose 4 years earlier. Again, doing that calculation is a time consuming, tedious process, expensive process. Why expensive? Because you will have to hire somebody who will do that valuation, and it consumes time, energy, efforts also. So therefore you follow this. But if you are so keen to apply retrospectively, that option is also available to you. But what about unvested option? Unvested option means their vesting period is still pending. Here we don't have relaxation. Sorry. You have to do retrospective calculation. Is it right? If options are unvested, no relaxation. Apply IND AS 102 from the very beginning. Calculate what would have been the balance today had I followed IND AS 102. So old GAAP figure liability 1 lakh. As per IND AS 102, the accountant says it should be 1,20,000. So I will have to book that additional liability 20,000. If it is a equity settled option, entry will be retained earning account debit to SBP reserve. If it is equity settled, and if it is cash settled, retained earning account debit to SBP liability 20,000 in our example, so that now the books get converted as per Ind AS 102 and henceforth you apply Ind AS 102. So this paragraph will be repeated in another standard Ind AS 101 also. That is the only point. Now next point is TDS on share based payment. This is also not very important because our institute does not ask questions on TDS. What is the full form of TDS? Tax deducted at source. Because you are going to give some benefit to the employee, deduct TDS. So how do you pass entry for TDS? Now in none of the institute question I have seen TDS related questions, okay. So chances are less that they will be asked, but you should know it. If law requires deduction of TDS at source, then following points are relevant. Record employee compensation expense with SBP reserve or SBP liability as usual. Okay. So your accounting till vesting date will continue as usual. What we have learned will be followed. On vesting date, TDS liability will be recorded on book value of SBP reserve or SBP liability. So what I'll do, if I have to pay TDS, if it is equity settled option, create a liability by debiting SBP reserve to TDS liability. And if it is a cash settled, SBP liability to TDS liability. So it is just you are deducting from employee and paying to the government. Is it right? Like your salary. In your office, your salaries are suppose subject to TDS. So company reduces the payment to be made to you and makes payment to the government. So that is the entry. If TDS is payable on equity settled option, SBP reserve to TDS liability. If TDS is payable on cash settled option, SBP liability to TDS liability. Now you will ask what will happen on settlement. On settlement, option will be exercised as usual. TDS liability will be paid as per the law. It is quite possible that your TDS liability that you have booked is different from what you have to pay. The difference will be transferred to P&L account. So on the exercise date, entry will be as usual, bank account debit, SBP reserve account debit to equity share capital to securities premium. This is for shares issued to employee, and then you have to pay tax to the government also because it is a form of employee compensation. So TDS liability, which we have already created in our book, to bank. If there is a difference, adjust it in profit and loss account if there is a difference. So this is about TDS on share based payment. Homework: major change in Ind AS 102 versus IFRS 2, and the answer is there is no change. TDS liability will appear in provision in balance sheet. Current liability or non-current liability depending upon when are you going to pay. Very good. Now I want to check whether you are listening to me or not for last 4 days. Okay? Participate. Correct answer will be given reward. Which of the following transactions involving the issuance of share does not come within the definition of share based payment? Employee share purchase plan, employee share option plan, share based payment relating to an acquisition of subsidiary, and share appreciation right. So go to scope paragraph, first page of this chapter, or if you can remember, you can answer right now also. What is not applicable? This chapter is not applicable to which of the following transaction? Is it applicable to share purchase plan? Yes. ESOP? Yes. SAR? Yes. And we have seen in the scope paragraph, it is not applicable to business combination. Yes or no? First page it is written below. Scope says not applicable for business combination. Business combination includes, so this is the odd man out. It is applicable for ESPP, ESOP and SAR. Have you noted the correct answer? Tang, tang, C. Try this one. Okay. Which of the following is true regarding the requirement of IND AS 102? Private companies are exempt. Small companies are exempt. Subsidiaries using parents' entity share as consideration for goods and services are exempt. There are no exemption from IND AS 102. Is private company supposed to follow IND AS 102? Yes. Any company following IND AS, will have to follow IND AS 102. If you come under the purview of IND AS, you have to apply. So therefore the answer is D. There is no exemption. Once you come under the IND AS net, all IND AS are applicable except those which institute will say is not applicable. But this is a very common standard. Try the next one. Third one. This will come as a 4-mark question without options. Okay. Suppose options are not there. It will become a question for your exam. An entity issues shares as consideration for purchase of inventory. The shares were issued on 1st January 20x4. The inventory is eventually sold on 31st December 20x5. The value of the inventory on 1st January 20x4 was 3 million. This value was unchanged up to the date of sale. Sale proceeds were $5 million. Shares issued have a market value of $3.2 million. Which of the following statement correctly describes the accounting treatment of this share-based payment? In your exam, the question will be, kindly describe the accounting treatment. Yes or no? If I change this, remove the option, it becomes a 4-mark question. So tell me, what is the accounting entry you will pass if it is a 4-mark question with amount? Will you record inventory at 3 million, 5 million, 3.2 million? 3 million. We have to apply the measurement date value. Measurement date is the date when inventory is received. Inventory is received on 1st January only. Inventory is received on 1st January. On 1st January, the inventory was having a fair value of 3 million. So entry will be inventory. First, you have to think yourself without reading the option. To SBP reserve 3 million. And because it is an equity settled option, this won't change. And this will be further accounted as per IND AS 1, IND AS 2. IND AS? You can make purchase or inventory account debit, whatever your software permits you. So now search for this answer. Equity is increased by 3, inventory is increased by 3, inventory value is expensed on 31st December. Whenever you sell it, you will expense it. Okay. First answer seems to be right. Let us read other option also. So this I will put it on hold. Okay. Equities increased by 3.2 million. Inventory is increased by 3.2 million. 3.2 is wrong. Because the standard says in case of transaction with non-employee, oh, that is supplier, first preference will be given to value of goods and service received. If that is not available or not reliable, then fair value of share will be taken. Since the fair value of inventory is available, I will not take fair value of the share. Then the equity is increased by 3 million. Inventory is increased by 3 million. First and third option are same. But this they are saying the inventory value is expensed over 2 years. That is wrong. Whenever you will sell, that time you will expense it. Okay. Third option is wrong. Whenever you will sell it, like in the first option, you will recognize the expense. We don't amortize inventory cost. We record it as cost of goods sold when it is sold. Then equity is increased by 3.2 million. So wrong. I will not read further also, because the answer has to be 3 first. So which is the right option? A. Fourth, an entity issues. Again, this can be a question for 4 marks if I remove the choices. An entity issues fully paid share to 200 employees on December 31st, 2004. Normally, these shares issued to employee vest over 2 years. Normally, it vests over 2 years, but these shares have been given as a bonus to the employee. Very good. Because of their exceptional performance during the year. So this is not given for future service. This is given as a bonus for services already rendered. For services already rendered means these are already vested. The shares have a market value of 5 lakh on 31st December and average fair value was 6 lakh. What amount would be expensed in the income statement for the above share based payment transaction? What amount will be expensed? If you think of 4 options, all 4 are available. You may think 6 lakh, that is there. You may think 5 lakh, that is there. You may think half of 6 lakh, 3 lakh, that is also there. And you may think half of 5 lakh, that is 250, that is also there. Answer. Options are already vested. I have given you a hint here. If options are already vested, the entire expense on the grant date will be recognized. Am I right? Say yes. The entire expense on the grant date will be recognized. Because the options have been vested. Because the options are already vested. So the answer is 5 lakh. Check. Do we have 5 lakh? Yes. Have you written the reason for that? If this question comes in the exam for 4 marks, without choices given to you, you have to write the reason also. Why 5 lakh? Because the options have already been vested. Normally it is 2 years. This is special case where out of happiness company has given them bonus for the exceptional performance they have already rendered. Okay, one last chance to improve. An entity grants 1000 share options to each of the 5 directors on July 1. The option vests on June 30, 2008. How many years are there? July 1, 4 to June 30, 2008. 4 years. The fair value of each option on July 1, 2004 is $5. So take $5, grant date 1000 employees, and it is anticipated that all the share option will vest on 30th June. What will be the accounting entry in the financial statement for year ended 30th June 2005? First you visualize yourself. Accounting entry with amount. Come on, come on, come on. Employee benefit expense to SBP reserve. Okay. Then you have to quantify 1000 option, 5 directors, 5 fair value, divide by 4 years. 6250. Without looking at the option, we think this should be the answer. Okay. Now look at the option and search for it. Do we have any option which contains what I wanted? Yes. Normally, if you solve like this is always going to be right, because this is what I wanted. This is what is there. Which is the answer? C. The correct answer is C. Have you got the calculation? 5 directors, 5 options, 5 fair value, 1000 option, divide by 4. And there is no change in any of the variables. This answer is over.